Welcome to Protect Your Assets. I am David Hollander, your host, and today I will be your drill sergeant as this entire month we've been rolling out our version of a retirement boot camp. We've done our best to help you jumpstart your New Year's resolutions, pay down your debt, save more money, pay less in taxes, and today avoid the landmines that are waiting for you. The inauguration's on Monday, and there's a whole new change coming your way. So for those of you joining us for the first time, welcome. People around here, they call me the Sandman, and that's because I help you keep more by staying out of trouble. Remember Humpty Dumpty? Well, these past few weeks, we've certainly had ups, we've had downs, and back up again. And next week, changes are coming. So you're going to hear the market segment here in a minute about what happened this past week. But moving forward for 2025, what are some landmines that you want to avoid, as volatility is definitely going to be, I think, more so this year than what we've experienced the last couple of years. So do yourself a favor and listen closely the entire show today as we go through some landmines that are waiting out there that you don't want to step on. It's a brand new year. There are big changes coming. You know it. So now's the time to make some moves. Take a big gulp of your ritual coffee. Get a pad of paper and a pen and get ready to become clear on your mission, soldier, as we roll out our retirement boot camp. All right, now let's get started. Well, it looks like inflation is under control, at least according to last Wednesday. Remember, we were talking about this last week. The Dow liked it, up 3.7% for the week. S&P 500 up 2.9%. We touched the 6,000 again, closed around 59.97, but got close again. NASDAQ had a decent week, up 2.4%. International index looking good, up 1.7%. 10-year Treasury down a little bit, which we like to see. Rates starting to go back down again, 4.62%. And oil pulled back a little bit as well, 77.45 a barrel, up 1.1 for the week. Oil looking like the big gainer so far this year, up 8% overall. So we talked about this last week. We were waiting to see this Wednesday coming out, the Consumer Price Index, which is a measure of inflation. And the week started out with the stock market down, looking like it was going to get worse, particularly if inflation was not cooling off, but it did since July. It's the first time we've seen a slowdown in inflation since July. And as soon as that came out, the market liked it and had a strong week, as you heard from the numbers we just talked about. But I want to caution you, it's not all about rates right now. It's also about earnings. And so last week, the banks kicked off the season, had strong results, as you would expect, across the financials. And this, of course, points to a favorable environment when it comes to the bigger picture. And the S&P 500 earnings right now are expected to increase, get this, 11% from a year ago. And so that looks strong. All right, so we're talking about double-digit gains this year. Is it going to happen again? Well, some people just say no. There's a lot of statistics. I went over this last week, all the big banks, what they're talking about, all the brokerage firms. Gave you all that information. So if you missed it, go check out our podcast. But bottom line, should this be another good year? Again, it's looking like it should be, but I just want you to know that it's going to be volatile. And if you're trying to set up yourself for income right now, you're going to be retiring this year, you're trying to get more income, you definitely want to pay attention to the landmines we're about to talk about, because these are the things that, even if your portfolio is making money, unless you're taking it out the right way, it could end up really hurting you. You could pay a lot more in taxes on it. You could lose some if the market drops and you need that income. You got to then sell things to live off of. So just be aware of all this. We're going to talk more about this today. It's not that easy. And so, again, the analysts overall are expecting 25 to be another good year. Will it be single or double digits? That's the question. Positive, or could it end up negative overall? If yields stabilize, in my opinion, back to rates again, and this is another big number. We got the Fed meeting at the end of this month. They're going to talk about rates and what they're going to do. I don't expect them to lower this time, but I do expect them to do it sometime this year. And so once that happens, once rates really do stabilize and start to move down, I think you're going to see a revival in equities in the value sector, the cyclicals, the small and the mid caps, like we saw towards the end of last year. But then once this started to change again, they fell off pretty quickly. So that rally fizzled, but it could come back. So again, you want to have exposure to these areas when the tide turns, and don't get caught, like Warren Buffett says, when the tide goes out, you don't have your pants on. When we come back, now that interest rates are starting to look like they're stabilizing and moving the other direction, and inflation is starting to get under control and cooling off, what are the 3 investing pitfalls or landmines that you want to avoid if you're thinking about staying in the market right now? Well, if you want to know what those are and what you can do about it, when I come back, we're going to talk about that. You are listening to the Sandman right now on the Protect Your Assets show. We will be right back. Welcome back. Welcome back to Protect Your Assets. I'm David Hollander. People around here call me the Sandman. And our goal is to help all of you live a more productive, less stressed life when it comes to your money, taxes, and estate planning needs. This entire month, we've taken this hour each week to help you get into financial shape and realize your 2025 goals. If one of your New Year's resolutions was saving more money, well, then the past 3 weeks have been for you. We had the Basics 101, just how to start a plan. And then last week we were really getting into the taxation of all that and how to supercharge your returns by looking at taxes and some things you could do. That was the advanced class. Today is going to be about landmines. What are some landmines that are coming here in 25 that you can avoid, again, to hope and protect more of what you've got? This is episode 3. And next week's going to be really interesting. It's the first time we're doing this. It's because a lot of you have asked me, you've said, you know, Hollander, you're looking a lot leaner. What's going on? And so I've been tracking this for about 2 years now. I don't know if you saw that Netflix show, Don't Die. I don't look like that guy, but and I'm not doing all the things he's doing. I'm just telling you that right now. But I'm doing a lot of things, and according to my biological clock on this app I'm using, I'll let you know about all this. I'm going to have experts here in the office, and we're going to talk about all this next week about how to anti-age. It is possible, and you can do it, and it'll be a great show. So that'll be next week. It'll be our wellness show. So that'll be next week. If you missed any of the past shows we were just talking about, then you should go listen to our podcast. We have all of this saved and available for you to listen to whenever you want. Wherever you get your podcasts, you just go there. If it's Spotify or iTunes, just type in Protect Your Assets, and it will pull up the podcast, and you can look at the Bootcamp 101 or Bootcamp 202 and find out what you missed. So we're talking about landmines to avoid in 2025, because let's face it, Monday, things are changing, right? You have the inauguration coming. There are some changes that are coming our way. We know this from previous administrations, previous Trump 101, now it's Trump 202. It's all coming. So again, there's things you can do to get ready for that. And the first landmine I want to caution you on, because I saw this again last week, we're seeing a lot of folks coming through making the same mistakes. And so you don't want to do that. So the first landmine to avoid, and it does take some work on your part, because what ends up happening is you just keep sticking money away in that bank. You're not paying attention about what you're doing because you're busy, and then you're not making any interest that you should be. It's just easy, free money in a way that would take you 5 to 10 minutes to do something about it and change it. So the first landmine is sitting on cash that pays you next to nothing. That's the first landmine. So the second one related to banks and savings is if you have a CD that's maturing right now or in the next 3 months that you bought maybe last year at this time, that's another thing that's coming your way, a landmine that if you step on it incorrectly, you're going to lose. You're going to lose money that you otherwise could have made had you just paid attention to this segment. So what I'm going to say right now is cash or short term is not a great place to be right now. Now, why do I say that when I'm talking about short term? So going out, say, 3 to 6 months, unless you're going to need that money to live off of. So I'll make an exception because I know a lot of you are going to call me and be like, well, you told me to put it in 3 months or 6 months. I would tell you that if that's the cash you're going to use to live off of from June through the end of the year. We're very focused when you come to talk to us about how do you live off of your money. It's very important. Remember, we're income people. That's really what we think about is income and how to generate income that will keep pace with your life, with inflation, with what you want to spend to stay in the Bay Area. Or anywhere you're hearing this, by the way. I know we're in other areas in California that are expensive. And so if you want to maintain your lifestyle and you want to have more capital to spend and live, then you should talk to us. This is what we do. We specialize in that. And so if I say, for instance, put it in a 3-month CD or a 6-month CD, that's because our plan says that you're going to start to draw down on that when that matures to cover your expenses. Maybe you said to us, we're building a kitchen out, or we're going to buy a new car, or we're going to go on a big trip, or whatever. Now, when I talk about your short-term capital, this might be money that's maturing in the next 3 months or a month or 2 months that you did a year ago. Rates are down. If you compare rates where they were a year ago today, they're off by about 0.5%. So when you go to renew, which we talked about this, when you go to renew, you're not going to make as much. Therefore, that's called investment risk. And the reason that's happening is because the Fed is consciously trying to lower rates. That's what they've said. That's what they're trying to do. There was a pause button, but with inflation numbers that just came out this past Wednesday, it doesn't look like it's forever. And I'm a student of the bond market. I like to look at the bond market. And if you looked at it this past week, you'll see a very interesting yield curve. What do I mean by that? Well, on the very short end, it's high. But within a year and a half, it starts to go down. And if you follow that all the way out to year 20, that's when it starts to go back up again. And then going to 30, it goes down again. So the yield is trying to figure out where it's going, just like we all are. But the market is telling us right now that a year and a half from now, rates will be lower. That means that if you're going to invest for longer, meaning you're going to live, say, 10, 15, 20, 30 years maybe, in retirement, you need to build a plan now that will pay you these great rates that are there now for a longer period of time. So, because that is likely to happen, meaning the Fed will continue to lower rates over the future, you need to avoid having a large portion of your savings in cash or in things that pay you very little to nothing, or that could mature in a year and a half to 2 years and pay you very little to nothing if rates are lower. Does that make sense? So what I'd like you to do, this is the exercise for today, is I'd like you to take a look at your December bank statement. Now, if you get those online, maybe they're e-delivered because you're saving paper, you can just go pull the statement. Like on your credit card, for instance, you probably don't get all those paper on every credit card you have, or your mortgage statement. Maybe it's delivered via email. Go back and take a look at your December statements, whether they're paper or whether they're on the electronic folder. Look at December and see, when it comes to your cash, how much are you earning on that liquid cash? And if it's not above, say, 4%, then you're not doing yourself any favors. That's right. You can write that down. That's where rates are right now on the things that we're looking at. Safe money. Why I'm saying this is because a lot of people have come through here lately with safe money, with bank money, with savings accounts, and they're making less than 0.5%. That's nothing. And when you add taxes on top of that, it becomes less than nothing because you have inflation eating away at your money. So you're going backwards. So I would encourage you to keep very, very little in these accounts and have your balances over 10,000. When they get over 10,000, sweep those to the types of accounts that we're talking about, where you should be able to get over 4% in a liquid money market. In addition, if you have any sort of bond, CD, maturing right now or over the next 3 months, then start to compare the rates that are out there. And I've seen anywhere on the 2-year, we do have a 2-year fixed insured, backed by the claims paying ability of this company, paying over 5.1%. So you can still get over 5 on the short end if you need that, say, in a couple of years. But I would encourage you to start to look out if you can. Again, this really depends on your situation, around the 15 to 20-year range, where, again, I'm seeing over 5% taxable on some good things. And if you're paying taxes, then you want to look at tax-frees around the same era. And we've got some really attractive rates there. What's the next thing you can do? Fail to regularly rebalance your account right now. This is another landmine that you could be sitting on right now and you're not looking at it. Because markets are not static. In fact, the last few weeks have proved this. They go up and they go down, and things are moving around right now. And sure, you've all done well the last couple of years, but don't get complacent. Complacent is not the standard. The standard is the standard. And so if you want to make more, you got to step up and look at it. What worked last year won't necessarily work this year, especially if interest rates continue to go down. That's because as rates fall, companies who make money off higher interest rates or that borrowed money incorrectly might have a problem. The cash flow will most likely compress for these companies, and that means their margins and their prices will actually go down. So let's say that last year your portfolio was a 60% allocation to stocks, 40% to bonds. And because of last year, which was a good year, now your accounts sit at 75% stocks, 25% bonds. And you're not doing anything. I would encourage you to rebalance now. Sell off a bit of your stock gains, put more of that elsewhere. Like what? I was talking about this at the beginning. Value, cyclicals, small cap, mid cap. Diversify yourself. Do it smartly. By doing that, you are creating a balanced portfolio that can take advantage of the new cycles that are coming. If you're not doing that, you're stepping on a landmine because you're going to blow your foot off when that thing explodes. Have you thought about what would happen if your house burned down? And I bring this up because right now we're facing a crisis in California when it comes to insurance. And if this is something you're considering as part of your cash flow for retirement, you need to look at that. That's another landmine. And if you're not getting in front of that now and looking at it with a team who knows what they're doing, which we do, we look at real estate, then you're creating a problem for yourself. So don't just wait and see what happens. Get confidence, know you're doing the right things, taking advantage of what's out there by using our on-track retirement review right now. This is not a cookie cutter form you fill out. We're going to look at your income, your taxes, your real estate cash flow, and what are your plans for your assets when you die. 866-PROTECT. Call the number now. Call us, 866-776-8328. If you don't know what I'm talking about, or you're uncertain, or you don't have clarity or plans around this, 866-PROTECT right now, and we will help you. Coming up next on Protect Your Assets, time for our popular They Say segment, where they say you should have high yield in your portfolio right now. I know the rates look good, but is that really a good idea? Find out. You're listening to the Sandman on the Protect Your Assets show. We'll be right back. Welcome back. Protect Your Assets. I'm David Hollander. People call me the Sandman around here. Being careful in the financial world. It's not easy. There is a lot of problems and things that can happen if you're not aware. So because we've been doing this for over 30 years, we have attorneys, advisors, and tax people on our staff. We see these things every week, and we love to share these stories with you so you can hopefully stay out of the way. This entire month, we've been doing our boot camp series where we help you keep your New Year's resolutions by giving you ideas to either save more money, pay less in taxes, or in this case, just avoid things that are coming your way here in 2025. So we have identified our top ideas, what we're talking about, and so we've been sharing those with you. And if you missed any of that, or you want to come to a workshop where we're actually getting into personal situations with folks right there live and answering your questions, this Thursday, because of popular demand, we'll be at Perry's in Larkspur. There are a few seats left. This sold out last time. We literally did not have an extra seat. So if you want to come, you better do this now. 866-PROTECT. Call them, let them know you'd like to come, or go to our website, libertygroupllc.com. Click on the events tab and you can register right there. There's a blue button. And the following week will be in Lafayette at that's Walnut Creek, right? It's Walnut Creek and Fleming's, excellent restaurant. So we'll be there doing the same sort of thing, which is again going over our top ideas, covering what we believe is coming, and then also answering your questions. Again, check it out. All right, so now it's time for one of our fan favorite parts of our show. This is our They Say segment where we debunk common myths, half-truths, sometimes just bad advice that they say. All right, so here's one they're saying right now. They say that when it comes to your balanced portfolio, you should have high yield in there right now. And is that a good idea? What do you think? Well, first of all, you should understand what you're doing there. I think right now that may not be your best choice, particularly given the difference in yield. There are some unknowns in the market right now. Let's face it, there's a whole big change coming. What is the new administration and Congress actually going to accomplish when it comes to making sure we don't go off the rails? Will the Fed be able to pull off the ultimate safe landing and continue to lower interest rates and keep things stable? How about the war over in Europe with Russia and Ukraine? We still have that issue over there. And let's face it, it's not just between the two of them. There's a lot of other people involved in this, countries. And if you're any sort of a theorist, read some of the predictions that are coming and when they're coming. 2025 is an interesting year. I don't know if you're into history like I am, but if you look at every 80 to 100 years, there's cycles that occur. And guess what? 25 is one of those cycles. So a lot's coming this year from all kinds of angles. And I would recommend that when you look at the yield curve right now, just looking at the market for what it is, if you see the difference, and again, I'm looking at the average right now. When I look 20 years out and I see what a triple B piece of paper across that inventory is paying compared to, say, an A or a double A, it's not worth it, in my opinion, to do that. The spread, in other words, the difference in what those are paying you, it's not worth it. So I would suggest you look at higher quality, better companies. Sure, it'll still be volatile. Just because you buy a name you know and it's paying you a good yield doesn't necessarily mean that's not going to fluctuate. So the thing you have to understand is if you're going to buy a 20-year bond, then you're going to sit and own it for the 20 years. Or when rates do go down at some point in the future, then you sell it and hopefully make a profit if that's what you want to do. You don't have to. You're holding it. As long as they're going to keep paying you, then you don't have a problem. But when you get into junk, talking about triple B or lower, that may look like they're paying great rates, and your friends may say, well, I'm making 6 or 7%. Well, what do you own? You start to scratch into it. It just doesn't look so good. It's not worth it. So that's what junk is. Junk is triple B or less in ratings in your bond portfolio. And historically, these things are called high yield. And sure, the yields look good, but you can lose principal and they can default. In fact, there's a higher probability that they will default, which means you lose everything. And if you're wondering what to do when it comes to that kind of question, well, you need a second opinion. And you should get one from a fiduciary who understands bonds and can explain it to you in a way that makes sense. That brings me to my next landmine. I touched on this last segment. It's real estate. I was sitting yesterday with my friend who owns a lot of apartment buildings. And we were talking about his cash flow. And he immediately brought up to me how many of his fire insurance policies have either dropped him or they're renewing right now at, get this, 700% increase in rate. 700% increase in rate. And he's still cash flowing positive, but he wasn't really thinking about it. And this is the thing I love about my real estate friends, is you've made a lot of money in appreciation over time. Sure you have. Because when you look at the value of that property and what you could sell it for today, it's a nice gain. And maybe you don't have a lot of debt like my friend. But when you look at the after expense return, the IRR on that value asset in your portfolio, what is your true rate of return? And when we sat there and ran the numbers yesterday, it was like 1.5%. And then so the discussion became, well, if I sell it, I'm going to pay a massive capital gain tax. That's true, but there's other ways to get out of that. You could do a 1031 exchange into something that you don't have to necessarily manage or deal with. We do this. The other thing that you're going to deal with in California is even if you use your estate plan to pass that real estate on to your kids, they're going to have to deal with Proposition 19. Maybe you're not aware of that. That's going to also increase the drain on your cash flow because you're going to pay more to the county in reassessments each and every year, which will detract from that cash flow to your kids. If you have not looked at this in terms of numbers, again, you're sticking your head in the sand and not looking at the issue. And I appreciate you may not understand it, but here we are to help you. We're gonna show you the numbers and how to think about it, so at least you can be educated about the subject and make your own decision. And now with the increased cost of insurance, in this guy's case, 700%. Then I asked him, is your kid really wanting to run that property when you die? And he said, no. My child told me straight up, I don't want that property. I'm not going to deal with that, Dad. I don't want to get a call at 8 o'clock on a Friday evening saying my toilet's broken. Come fix it. Ask yourself the question, do your children want to deal with this? Ask them. And if they say no, then be honest with yourself. What are you afraid of? Look at the issue. Think about it. We can show you what you need to do right now before it's too late to lock in that cash flow for you and then for your family, if that's important to you. Because by being informed, you can actually make better decisions. So because you're listening right now, we're going to go ahead and run these numbers for you. We have real estate spreadsheets. We do this. We can help you look at it from an economic standpoint as opposed to an emotional one. 866-PROTECT. Call Lucas. He's there right now. He's back there. 866-PROTECT. Say, hey, Lucas, can you help me figure this out? I just want to look at the numbers. No cost to do this right now. 866-PROTECT. It's your money. You want to keep more of it, then get in front of this now. It's time for a quick break, but when I come back, what should you be investing in right now? You don't want to miss this one. You might learn something. We'll be right back. Welcome back. I am David Hollander, and you're listening to Protect Your Assets this morning. You know, at the Liberty Group, our goal is to help all of our listeners live a more productive, less stressed life when it comes to their finances. That's why this entire month we've taken this hour each week to help you get into financial shape for 2025. If one of your New Year's resolutions was getting your finances into shape, then this series is just for you. Today's episode is the third boot camp where we are talking about the landmines that are sitting out there in 2025. We've put our top ideas together to bring this content to you today. If you missed any of this past segments, we were just talking about the things you got to watch out for, then you definitely want to listen to the first parts of the show at our podcast. You can check that out anywhere you get your podcast. It's Protect Your Assets. Or more importantly, we are doing workshops again where we're getting into your own personal situations. Like I was talking about my friend who owns real estate, who was here in the office yesterday, and we were going through this, figuring out what he should do. If you want to come to an event and ask us questions, feel free to do it. Go to our website, libertygroupllc.com, click on the events tab, and you'll see all the events that are coming up in your area. And you're welcome to register right there and just show up and bring your friend. As I was talking about, this is the landmine show. And so right now, what is one area you want to take a look at? Well, as I was talking about, rates have just started to go back a little bit this past week, given the inflation number we saw on Wednesday. What does that mean? It means that bonds that were down at the top of the week in terms of the total return, if you look at the price of the bond, most likely some of those, particularly the higher yield ones, have been a little bit more volatile, moving around a little bit. And because rates just came back a little bit, more than likely now would be a good time to look at quality. So what you're doing is you're essentially getting out of something that has the potential this year, if things don't go so well, and there's more volatility to lose more, to shift that into something that has a little higher quality, maybe lower yield, but still something you could live with and be happy about, and lock that in for a longer term. So over time, once again, you feel a little more comfortable with what you're involved in. And so where you want to look at right now is on the corporate range. If you're looking at taxable income, corporates that are better quality, mid-range, I'll call it, in terms of the yield curve, I'm seeing better than 5%. If you pay taxes on your taxable money, then you should be looking at tax-frees right now. And in several cases, we have different types of tax-free income right now that, depending on your tax bracket, if you're in the top tax bracket, we're seeing a tax equivalent yield now. We can explain what that means and how you figure that out, of over 7%. That's the tax equivalent yield, not the yield, the tax equivalent yield. And so if you can make that kind of return over the long haul with a safer investment, that's not bad. And if you are 67 or older right now and you have a birthday that's coming up soon, we have another strategy right now where you can get almost 8% in lifetime income that's backed by the claims paying ability of that company for your entire life. These companies have been around through the Depression. So find out what these are and what this is, because like I said, rates don't last forever. They do move. And the Fed has said that they want to get the inflation rate close to 2% and that they are wanting to lower interest rates over the next couple years. That's the plan right now. And if you look at the bond market, it's reflecting that. So I don't fight the Fed. Hope you don't either. And right now, when things are happening now, it's the time to take action. If you don't know what I'm talking about, or you would just like some help, or maybe you haven't had these kind of conversations with your advisor, then I'd like you to do yourself a favor this morning. Inhale through your nose. Exhale through your mouth. And in your mind, picture a day when you don't have to worry about your income or taxes, or how you're going to pass your assets to your kids anymore. Picture a day when you can relax, travel, and do all the things you've always wanted to do, it all starts with the conversation, and you need to take action. So pick up the phone right now and talk to Lucas, Zach, or Phil. They're sitting back there right now. All three of them. Call them right now. Call us, 866-PROTECT, and we will run a plan for you and show you what we can do. It really is that easy. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. My executive producer, network manager, Kevin Renfer. And, of course, all my fabulous producers back there doing all the work, but not being seen. You got Raph, you got Luke, you got Zach and Phil. Because without my team, I am just another pretty voice on the radio. You have been listening to the Protect Your Assets. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.